In 2001, HIH Insurance appeared solvent on paper, but its cash position could no longer support the claims it had already committed to pay. That gap mattered immediately because policyholders depended on those payments, and the moment claims stalled, confidence across the market began to break. Years of reported profits had masked the real condition, where liabilities were consistently underestimated and risk was quietly building beneath the surface. Those numbers mattered because they shaped investor trust, yet they led directly to decisions that expanded exposure instead of reducing it. Reinsurance arrangements were used to defer losses, creating the appearance of stability, but they ultimately delayed recognition of a problem that was growing larger. That delay mattered because it allowed the system to continue operating long after it had already become structurally unstable. Acquisitions added scale and complexity, bringing in liabilities that were not fully understood, which further weakened the balance sheet. When claims began exceeding expectations, the company had no financial buffer left, turning a solvency issue into a liquidity crisis within weeks. What looked like a stable insurer collapsed into a $5 billion failure, revealing that solvency had been an illusion all along. In March 2001, HIH Insurance announced it could no longer meet its financial obligations, immediately exposing a solvency crisis that had already been building beneath the surface. That announcement mattered because it signaled not a temporary issue, but a structural failure where available cash could not cover existing claim liabilities. Policyholders began facing uncertainty over payouts, which quickly translated into loss of confidence across the insurance market. Investors reacted as the gap between reported profits and actual financial position became visible, triggering a rapid collapse in trust. Regulators moved in to assess the situation, and early findings indicated that the company's balance sheet had significantly understated its liabilities. That discovery mattered because it showed the problem was not sudden, but the result of years of accumulated miscalculations. Claims obligations continued to rise, while incoming premiums could not offset the exposure, tightening liquidity further. The company had no immediate way to raise capital or stabilize operations, turning pressure into inevitability. What began as a solvency concern was now clearly an insolvency event, leading directly into how the system had been built to fail. Long before 2001, HIH had expanded aggressively through acquisitions, turning itself into a global insurer while quietly increasing exposure it did not fully understand. That growth mattered because scale created the illusion of strength, even as the underlying risk profile became harder to measure and control. The 1998 acquisition of FAI Insurance added billions in liabilities, but due diligence failed to accurately capture the true cost of those obligations. Those hidden liabilities mattered because they immediately weakened the balance sheet, yet were absorbed without correcting pricing or reserves. Premiums continued to grow, but pricing remained too low for the level of risk being taken, locking in future losses with every new policy written. That mismatch mattered because revenue looked strong in the short term, while long-term liabilities expanded faster than capital. Reinsurance agreements were used extensively, allowing HIH to shift losses forward, creating temporary relief instead of solving the problem. That structure mattered because it delayed recognition enabling the company to report profits while actual exposure continued increasing. By the time the system appeared stable externally, the internal balance had already shifted toward failure, leading directly into the hidden fracture inside its financial model. Inside the balance sheet, HIH was consistently underestimating its claims liabilities, recording reserves that were billions lower than what future payouts would actually require. That gap mattered because insurance depends on accurate forecasting, and every underestimation directly translated into hidden losses building over time. Internal risk models failed to capture long-tailed claims, particularly in areas like workers' compensation and liability insurance, where payouts emerge years later. Those blind spots mattered because they allowed the company to appear profitable while obligations were silently accumulating beyond visibility. Reinsurance was structured in ways that deferred losses into future periods, effectively smoothing financial results while increasing long-term exposure. That mechanism mattered because it replaced real solvency with accounting presentation, delaying recognition until the system could no longer absorb it. Board oversight remained weak, with limited challenge to management assumptions, allowing aggressive accounting practices to continue unchecked. That lack of governance mattered because it removed the final control layer that could have forced early correction. By the time liabilities began surfacing in real terms, the system had already moved beyond recovery, pushing the company into an irreversible escalation phase. By 1999 and 2000, warning signals were already visible as claims costs began rising faster than premiums, tightening margins across multiple insurance lines. That shift mattered because it showed the business model was no longer sustainable, yet expansion continued instead of correction. The FAI acquisition started revealing deeper problems, with previously undisclosed liabilities adding hundreds of millions in unexpected exposure. Those discoveries mattered because they confirmed earlier due diligence had failed, but the response was delayed rather than decisive. Capital buffers began shrinking, with solvency margins narrowing to levels that left little room for error under regulatory requirements. That erosion mattered because insurance stability depends on excess capital, and once that buffer weakens, collapse risk accelerates rapidly. Auditors signed off on financial statements that did not fully reflect the underlying exposure, allowing the company to maintain the appearance of stability. That approval mattered because it reinforced external confidence, preventing early intervention that might have limited the damage. Management continued writing new policies to sustain revenue, locking in additional future liabilities that the system was no longer capable of absorbing. By late 2000, claims outflows accelerating sharply, with payouts rising faster than projected and beginning to strain available cash reserves. That surge mattered because it exposed a liquidity mismatch where incoming premiums could no longer sustain the volume of claims being triggered. Reinsurance recoveries failed to arrive at the scale expected, leaving HIH directly exposed to losses it believed had been transferred. That failure mattered because it removed a critical layer of protection, instantly widening the gap between assets and liabilities. Attempts to stabilize the position through internal adjustments came too late, as the capital base had already been eroded by years of under-reserving. That delay mattered because once solvency margins fall below critical thresholds, recovery options become extremely limited. Credit confidence weakened making it nearly impossible to raise new capital quickly enough to cover the emerging deficit. That constraint mattered because insurers rely on trust to access funding, and once that trust breaks, liquidity disappears. At this point, the system had crossed its point of no return, where collapse was no longer a risk but an outcome already set in motion. In March 2001, HIH was placed into provisional liquidation as it became clear the company could no longer meet its obligations to policyholders. That action mattered because it confirmed the failure was systemic, not temporary, with liabilities far exceeding available assets. Initial estimates revealed a deficit of over $5 billion, making it one of the largest corporate collapses in Australian history. That scale mattered because it exposed how deeply the risk had been embedded across multiple insurance lines and jurisdictions. Policyholders were left uncertain about claims payments, forcing government-backed schemes to step in and limit broader financial damage. That intervention mattered because it prevented immediate contagion, but also highlighted how critical the failure had become. Operations ceased and assets were frozen as administrators began untangling a complex web of obligations and reinsurance contracts. That process mattered because it revealed how opaque structures had delayed the recognition of losses until collapse was unavoidable. What had appeared to be a functioning insurer was now formally dismantled, leading directly into accountability and systemic reform. In the aftermath, a royal commission was established to investigate how HIH collapsed despite appearing solvent just months earlier. That investigation mattered because it uncovered systemic failures in governance, accounting, and regulatory oversight that extended beyond a single company. Findings revealed that liabilities had been underestimated by billions, with inadequate provisioning practices distorting the true financial position. That exposure mattered because it showed how accounting decisions directly shaped risk perception, allowing the system to operate under false assumptions. Senior executives, including CEO Ray Williams, faced legal consequences, reinforcing accountability for decisions that accelerated the collapse. That accountability mattered because it signaled that structural failures at leadership level could no longer go unchallenged. Regulatory frameworks were strengthened, with APRA increasing supervision and enforcing stricter capital and reporting standards across the insurance sector. Those reforms mattered because they aimed to prevent similar collapses by improving transparency and early detection of risk. The HIH collapse ultimately redefined solvency in practice, proving that when risk is hidden long enough, failure becomes inevitable rather than unexpected.